Hello everyone and welcome back to the sessions on financial management. Friends, in this class of financial management, we are continuing with the topic ratio analysis. And within the topic ratio analysis, we are going to discuss a very small, a very simple but an important concept titled as Dupont analysis. Now, what is this Dupont analysis? If you could see in past exam question papers, many a times they have asked a 4-mark question on Dupont analysis, and in your study material there is a lot of theoretical explanation given about this, including some numerical examples, but sometimes students tell me that it is difficult to read and understand from what is given in the study material. But believe me, my friends, this is a very simple concept, provided you have kept a track of all the ratios that we have learnt in the earlier classes. So basically, Dupont analysis is about analyzing an important ratio which is called return on equity. Now, return on equity is found to be a multiple of 3 other important ratios. So friends, let us do one thing. Let us first have a quick look at those ratios which I am talking about. I will display those ratios here on the screen. You need not even write that, your notes already contain these ratios. So just give a quick recap of this and then we understand how Dupont analysis works and how these ratios are interconnected. So your attention on the screen, please. So friends, as I have just mentioned, you need not even write these ratios. In the earlier classes you have written all these ratios. I just want you to have a quick look at these important ratios. So here we are talking about net profit ratio, assets turnover ratio and total assets to shareholders funds, and at the end it is return on equity. I am sure I don't have to explain you these ratios again. We have already learned these in the earlier classes. So what I am going to do is, I am going to put forward an example through which you will be using these ratios and you will understand how Dupont analysis works. But before I take that example, let me first explain one important concept. What I want to explain before we take that example is a simple point what you can find on the screen. The first ratio is a net profit ratio. What you have done to find a net profit ratio, it is the net profit after tax divided by total sales. The next ratio that we have considered is the assets turnover ratio, where the numerator is total sales and the denominator is the total assets. And in the third ratio, we have taken total assets divided by shareholders funds. So if you can just mathematically understand one simple equation, if I multiply the first 3 ratios, you can just check at the screen and you will get the analysis on your own. The result will be, the numerator will then contain net profit after tax and the denominator will finally be the shareholders funds, and what we get finally is the return on equity. So what I wanted to explain is, as per Dupont analysis, the ratio return on equity is a multiple of these other 3 ratios, that is net profit ratio, assets turnover ratio and total assets to shareholders fund ratio. This total asset to shareholders funds ratio we have also understood as leverage ratio. So when suppose you have total assets of 30 lakhs and your total shareholders funds is 15 lakhs, we can say that the total assets are twice the amount of shareholders funds. In other words, it is a hint that the company is using financial leverage. That means the company is using debt fund also as part of the capital. So let us now take up that example and understand the multiplication of these three ratios, how it results into the return on equity. Alright friends, so let us take up that example. Dupont analysis. Consider the following example. You have total sales as rupees 40 lakhs. Net profit after tax is rupees 4 lakhs. Total assets rupees 20 lakhs and shareholders funds is rupees 16 lakhs. Determine the following ratios: net profit ratio, assets turnover ratio, total assets to shareholders funds, and return on equity. And the last thing in the example is specifying that explain Dupont analysis based on your calculation. So friends, let us do one thing. Let us first write up this example. So I am giving you time. Quickly take note of these facts and figures. Alright friends, you would have finished writing this example. So let us go ahead and start calculating the ratios that are required in this example. So one by one. To begin with, it is net profit ratio, which is net profit after tax divided by total sales into 100. As per the information available in the question, it will be 4 lakhs divided by 40 lakhs into 100, and that would be 10%. And now assets turnover ratio will be total sales divided by total assets. Total amount of sales is 40 lakhs and total assets are just rupees 20 lakhs. So assets turnover ratio results into 2 times, which indicates that the total turnover or the total sales is twice the amount of total assets. Friends, quickly take note of these two calculations and then we shall move ahead. Alright friends, you would have finished writing these two ratios. Let us now move ahead and determine the other two ratios. So total assets to shareholders funds, simply total assets divided by shareholders funds. As per information given in the example, we have 20 lakhs divided by 16 lakhs as 1.25 times, and return on equity finally will be net profit after tax divided by shareholders funds, and what you can get is 4 lakhs divided by 16 lakhs into 100, that will be 25%. Into 100, why we are making is just to indicate that ratio in the percentage form. If you do not multiply 100 over there, you can simply write it as 0.25 also, but generally it will be a tendency to report any kind of rate of return on a percentage basis, which is always a preferred way. So quickly take note of these two as well, and then we move ahead. Alright friends, you would have finished writing the calculations. Let us now move ahead and start with that analysis. So what we find under Dupont analysis is that return on equity is a product of three important ratios, that is net profit ratio, assets turnover ratio, and financial leverage, that is total assets to shareholders funds. So let us just multiply these three ratios as per the calculations that we have obtained. So return on equity will be obtained as net profit ratio multiplied by assets turnover ratio multiplied by total assets to shareholders funds. So when we consider net profit ratio, it was 10%, or you may write it as 0.1. Assets turnover ratio was 2 times, and total assets to shareholders funds was 1.25 times. When you multiply these three, what you get is 0.25 or 25%, which we have originally obtained as return on equity. So friends, quickly take note of this analysis, and then we move ahead and we will write a little bit of description about these three important ratios as well. Alright friends, you would have finished writing this analysis. Let us do one thing. Let us write some description about these ratios. Now, in the first lecture of ratio analysis, we have learnt the ratios along with their interpretation and analysis. We have done that for each individual ratios, correct? But here, just as an added explanation to this analysis, let us write some description. The first thing is about net profit ratio, which indicates the net margin after tax with respect to sales, which in the given case is 10%. Assets turnover ratio of 2 times indicates that for every rupee 1 invested in assets, the company is capable of achieving sales of rupees 2. Never forget one thing, that all these turnover ratios contain the sales in the numerator, right? So assets turnover ratio will be turnover divided by sales, and which is 2 times, which clearly indicates that the amount of sales is twice the amount of assets. And the right way to understand this ratio would be that for every 1 rupee that the company has invested in assets, the company is capable of achieving sales of rupees 2. Now, financial leverage of 1.25 times indicates that against each rupee 1 of shareholders' funds, the investment in assets is rupees 1.25. That means if you have made an investment of 1.25 in assets, your shareholders have contributed rupee 1 only out of that. That means the balance 0.25 indicates the use of debt or borrowed funds as part of your capital. So this ratio indicates that along with equity, the company is using external funds to finance its investment in total assets. So friends, do one thing, please write up this whole description, and that will be end of the analysis.